Look, I mean, I was in Anglo Platinum for 18 years before I came across to Kumba. I've had a fantastic stay in Kumba, and it's a great team and it's a great business, and I'll be heavy-hearted to leave this great team and this great company. But at the same time, change, I think, is good for the company, it's good for individuals. So with a small amount of trepidation and looking forward to the new challenge, I think that's the frame of mind that I'll go to Anglo Platinum. But one thing, when you've been in the industry for 20 years or longer, you see the cycles in the industry. So, and I think it's very important to keep perspective. The platinum industry itself is in a difficult down cycle at the moment, but it'll turn. The world needs platinum. It's a good metal, and it's a good contributor to South Africa, and it's a good contributor to Anglo-American. So I think there's still lots that we can do, and I'm looking forward to the challenge, and I'm looking forward to when the cycle turns.
So let's talk about Kumba's results. Obviously, for the first half of the year, volumes increasing 13% to 21.6 million tons. To what extent has the introduction of Kolomela helped to increase production this time around?
Sishen has been now for the last 2 years or so, because we had the ramp up of the jig plant, so a very substantial increase in production at Sishen. That is now ramped up, and it's now at a stable 41 million tons. So the new production will be coming from Kolomela mine. So although Sishen mine was a little bit down in this quarter, most of the production has come from Kolomela. Kolomela running very well, way ahead of the market expectation, well ahead of the guidance that we've given. And so our additional production is indeed coming from Kolomela, and that's why we've been able to see the company continue to grow.
From a Sishen perspective, though, as you say, production falling back slightly there, what are you doing to remedy that?
We've been guiding the market since 2009 that we need to do additional waste stripping as the ore body dips towards the west, so we need to do additional waste stripping, and we've guided the market that there will be a period of time that the mine will be constrained, and we need to do this additional stripping to be able to create the flexibility that we need. So we're going to see quite tough operating conditions at Sishen for a couple of years. We've been doing the waste stripping just as we've told the market. Again, this year we'll be within our guidance of the amount of waste that we need to strip. So I think we know what we need to do. We're doing that and executing it, and under those conditions, Sishen is going to be tough. But at the moment, it still continues to produce very substantial amounts of ore and make substantial amounts of money for the company.
Let's talk about the export market, because export volumes hitting record levels this time around to 20.7 million tons. You're still predominantly exporting to China, so still very much dependent on the Chinese economy. Is the slowdown in China affecting your exports to them?
So our exports have not been affected at all, and haven't been affected for the last couple of years. I think, as you rightly say, is the majority of our ore we supply to China. China, given the total amount of ore that China needs, our ore is minimal. So we're unlikely to see, even if there are some cutbacks in demand from China, because of the quality of our ore, it's unlikely that we will be affected under a cutback scenario. So we're not constrained. We supply to China. All of our ore is taken up. But at the same time, we also have Europe and then Japan and Korea that also take predominantly our lump ore. And we have a bit of flexibility in those markets. We all know the difficulty that's going on in Europe. Japan, although the strength of the yen and some of the difficulties they had last year have meant that their steel industry is not doing so well, we still sell the ore that we should be selling to Japan and Korea. All that ore is still flowing to those regions, although we have an ability to move slightly between the regions. So I think we've got sufficient geographical flexibility, but then the engine that is China continues to consume most of our ore.
On the cost side of the business, cost pressures throughout, that's been reflected in unit cash costs up 21% to 182 Rand per tonne. Are you operating as efficiently as you can? Are you able to bring this unit cash cost down further?
Look, one of the things that we've said when we started our waste ramp up in 2009, we've been very clear to the market what this impact on the unit cash costs will have. So we've guided that in addition to normal mining inflation, which is a bit higher than normal inflation, we've said in addition to that, you need to expect that there will be about a 10% increase as a result of the additional waste mining. So I think we've been very clear to the market to expect the kind of unit cash costs that we're seeing at the moment, and that just because the company is making record profits and has a very high margin, just because of that does not mean that our cash costs are running away from us. This is very well controlled. We know where the costs have to be spent, and we've guided the market very clearly that this is the range of increase in cash costs that we're likely to see for the next 3 years at least.
In terms of the price of iron ore, though, that's been coming down quite substantially, sitting at an 8.5-month low at this point in time, just above $125. And it continues to be under pressure at this point in time. I mean, do you have a level at which you will actually turn into a loss-making operation, or is that still far off? What is that level?
We currently have a 57% margin, I think it was this year. This first half of the year. So with a 50% margin means that the price could almost half from where it is now, and we'd still be making a profit. So we are very far away from making a loss. The price is not going to fall anywhere near to where it will start affecting us. By then, being in the first half of the cost curve means that the half of the iron ore producers in the world will have to fall by the wayside before we start getting pressure on profitability. So now I think we're in a very good position, and that comes from two reasons. Because of our cost is low and we're in the low half of the cost curve, we need to protect that position. But because of the current prices so far away from where our costs are, we're able to make a good margin.
BHP is increasing iron ore production, so too is Rio Tinto. With so much more iron ore set to come onto the market, how is this going to impact supply in the market?
You see, all of these things are factored into our models about where we think the price would be. So you've mentioned on the demand side, nothing fundamentally about what you've mentioned now is not taken into account of our demand. The fact is that demand across the world, so this is steel production, is increasing every year. Even China, China, we're speaking about the slowdown in China. China this year will produce roughly 720 million tons of steel compared to 680 million tons last year. So that's still a very substantial growth in steel production only in China. And the other areas of the world, not growing substantially, but still growing. So every year you need more iron ore and more iron ore. And it's the responsibility of the miners to respond so that you don't make the price go too high.